Okay, guys, let's begin. Thank you all for joining today. I'm happy to share with you an overview of our mobile home park and self-storage portfolio investment opportunity. Now, both these asset classes have been among our preferred investments for really over a decade now. And we believe they have a very strong potential to perform exceptionally well over the next 10 years. And so as you can see on the screen, investors are projected to earn an average annual ROI of 14 to 17% and a 1.75 to 1.85 equity multiple. Now, throughout the presentation, guys, feel free to ask questions. You can use the chat box at the bottom of your screen. We will get to all the questions at the end. All right. A brief disclaimer, all investments involve risk. You should consult your attorney, financial advisor, or accountant to understand the risks of the investment prior to consideration. And none of the information here today is an offer to sell or buy a security. That can only be done through the offering documents. Okay. So let's dive in. Today's agenda, we're going to take about 25 minutes or so, start with key investment benefits. What do we feel some of the priorities of this investment are and the attributes associated with it? Why are we choosing to invest in mobile homes and self-storage in the first place? From there, we'll discuss the details of this portfolio, discussing some of the advantages, the immediate diversification that we achieve as investors, the fact that distributions have already commenced, conservative leverage being used in the portfolio. And then there's already been significant value add created. This portfolio opened in middle of 2023. And so there's been a lot accomplished already. We're excited to share some of those details with you, including providing some examples of the value growth on various self-storage and mobile home park opportunities or properties in the portfolio. From there, we'll do a quick overview of our operating partners, their background, experience, and track record. We'll then review the projected investor returns before we open it up for questions and answers. All right, so I'm pretty excited today to present really what we would consider a premier opportunity to invest into a well-established, rapidly growing portfolio of mobile home parks and self-storage facilities. This is in partnership with a repeat operating partner of ours. And just a full disclosure, all the pictures on the screen here are actual properties in the portfolio. So just want to make that clear as well. So some of the key investment benefits, this is a professionally managed and audited fund that we're investing into with a repeat operating partner. They are combining lowly correlated recession-resistant asset classes for passive investors. And it allows us to diversify across asset types, regions, and properties, and also on different value add strategies within those properties, which we'll cover more in a few minutes here. They're targeting assets that generate current income and have the opportunity for appreciation. And we're targeting an attractive risk-adjusted return, wealth creation, while focusing on capital preservation and downside protection. And that is done through various measures. A few of those are just the idea of investing in a portfolio that provides us with a blended return of consistent income, and appreciation through asset value growth. We're also earning income from a lot of the value add strategies, including increasing rents at the properties and expense reimbursements, in addition to filling vacancy, increasing occupancy, and other measures as well. And we do find these two asset classes, the residents and tenants, are often less price sensitive compared to other asset classes. Lastly, here, the investment is projected to provide quite favorable tax benefits through accelerated depreciation and cost segregation. We're estimating that investors will earn passive losses in 2024 and 2025. All right, why mobile home parks? We've been loving this asset class for over a decade. Personally, my family, our company has been investing in mobile homes for quite some time now. And let me share with you some of the attributes for some of you that may not be quite as familiar with this asset class. So mobile home parks typically rent the land to the tenants or the residents that own the homes on the land. And what you can find in a lot of communities is a pride of ownership and lower maintenance costs for the park owner. Low expense ratios generating, higher profit margins because the residents own their homes. They're responsible for the maintenance, the upkeep of their actual home, which reduces expenses, of course, for the lot owner. We often see high resident retention due to, honestly, a lack of affordable options in the United States. And it's quite expensive to move a mobile home, anywhere from $5,000 to $10,000, which makes it a bit prohibitive. In fact, there's data out there that shows that 90% of mobile homes are actually never moved. We find that lot rents are stable, predictable. They often continue to grow even through recessionary periods. And we'll share more data on that in just a minute here. There is a very strong increasing demand for affordable housing throughout the US. I'm sure many of you can see this in your local communities. Right now, there's about 21 million people living in mobile homes. It's about 6% of US households. And we do find it to be one of, if not the most affordable housing option. And we see growing demand from retirees. A lot of them are choosing to live in mobile home parks. They're downsizing due to low or fixed incomes. Another unique attribute that you don't see in most any other real estate is the limited supply factor. The supply of mobile homes is estimated to be flat or declining. It is very difficult to build a new mobile home community due to a lot of the barriers to entry, including zoning restrictions, NIMBYism, not in my backyard, and it essentially creates a moat around the asset class where there just is not a lot of competition. As we mentioned before, there's some favorable tax benefits here. Mobile home parks in particular allow us to defer the tax burden due to accelerated depreciation for the land improvements. And they have a 15-year depreciation schedule versus 27 and a half years with residential real estate. There's also a lot of market inefficiencies. This is one of the areas that our operating partners focus specifically on. Buying properties, mobile home parks from mom and pop owners. A lot of times they're being mismanaged, they're underperforming, and they can be purchased at a discount with a lot of value add and room to improve by essentially bringing in professional management. You can improve the operations, fill vacant lots, create additional lot revenue, and really enhance performance. Okay, let's shift over. Why self-storage? Some of the data behind self-storage, our experience investing in it, and why we love this asset class as well. Think about the cost of a self-storage unit. It's around $85 a month on average. That's typically seeing high tenant retention. Again, similar to mobile home parks. The idea of, on a Saturday leaving your house to go and move all your stuff out of a storage unit takes time, costs money. It's an effort and expense to move that. And so you end up seeing a pretty high tenant retention, which we love in this asset class. And just recently, it was noted that over 11% of Americans rent a storage unit. So a very, very large market and strong demand. One, I would say, a high quality attribute of self-storage that we like, you have month-to-month leases versus an apartment, typically 12 months, self-storage or month-to-month. And so you can adjust rents up and down as needed with the market. It allows you to be flexible during tough times and also increase rents more aggressively during high growth times, especially if you're in a undersupplied market. This often relates to rent increases of 6 to 12%. It's common to see those kinds of growth measures on the rent just due to the low dollar value of rental rates. If you think about paying $85 a month and your rent goes up $10, you're essentially not necessarily going to pack up your belongings and take off and go find somewhere else to move. Historically, self-storage has been one of the lowest delinquency rates of all real estate sectors. And it's got a very strong track record through multiple cycles. We have a chart on this we'll share in a moment. Self-storage has outperformed other real estate for decades. You tend to see stable and continuous cash flow with long-term appreciation potential. And it's a low overhead business model. This is one of the other attributes we like. Operating expenses are often lower than other real estate. If you think about it, you're essentially renting out a box with a roof. There isn't plumbing. There often isn't electricity, or excuse me, there's electricity. There often isn't air conditioning or heating unless you're in a ventilated unit, of course. And so that just reduces utility expenses for the park owner, which, as we may all know, have gone up tremendously in the last couple of years as inflation has increased. The cost of utilities has expanded drastically as well. And so self-storage has been somewhat immune to that. And overall, buildings are easy to maintain. They require minimal staff. A lot of times you can operate a 750 unit to 1,000 unit self-storage facility with, 2 full-time people. Now, we mentioned quickly that these are mom and pop asset classes. We want to talk quickly more about that, what we mean and why this matters. And so essentially you have 2 asset classes primarily owned by individual investors. They own 1, maybe 2. A lot of these owners aren't capturing the full potential of their asset. And you can look at this chart here for mobile homes, showing that roughly 85% of mobile homes in the US are owned by mom and pop operators, and only about 15% by portfolio operators or institutional private equity type groups. Self-storage, similarly, right, about 73% of self-storage in the US owned by small operators. Again, this provides an opportunity to buy and renovate and fix and improve properties that otherwise haven't been already pushed to their full potential. Mobile home parks, historical net operating income growth. We want to share with you some of the data on how mobile homes have performed through multiple market cycles. We note here that they've long been a recession-resistant asset class. We feel that in uncertain times, there are few better places to have capital deployed. And so if we look at this chart here, this is from Equity Lifestyle Properties. They are the largest mobile home lot owner in the US, and they've essentially owned and operated mobile homes for decades. And what you'll see here is that they have been able to provide and maintain positive net operating income growth in all quarters, going back decades. And so if you look at this first arrow, it's showing in blue here, this is ELS, positive net operating income growth. And this is during the dot-com bubble. And if you fast forward here, this is the Great Recession, 2008 and 9, continued net operating income growth. And then even more recently through COVID as well, this third arrow. And what you notice is during these periods, other REITs and apartments have each time had negative net operating income growth. So it really just signifies the resilience of the asset class through varying market cycles. Okay, we also have constrained supply. We touched on this briefly just a minute ago, but essentially what you're seeing here is there is very few manufactured housing or mobile home parks being developed in the US. Again, due to a lot of the restrictions of NIMBYism, not in my backyard, restricted zoning and regulations, making it really difficult to get approved and for the actual project to pencil for developers. Again, providing us with a competitive advantage in this asset class that you don't see in much other real estate. Now, self-storage has also performed very well during downturns. We do consider it to be recession resistant. You can take a look at this chart at comparing 2008 financial crisis and the COVID era of 2020 and how total returns by property sector, you've got 2008 in light blue and 2020 in dark blue, and you can see self-storage over here on the right, positive during both of those time periods. All right, now I want to change gears quickly and just show you how pricing has fluctuated over the last 7 years or so. And this is a chart from Green Street Advisors that we constantly look at and update. It's the 7-year cumulative change in pricing or value of these properties. And they're covering a pretty wide array of different commercial real estate sectors, from malls down here in blue, office in gold, healthcare in orange, net lease in green. And what you see here is that manufactured housing, which is mobile homes, in gray, and self-storage in black, have done quite well up until the peak in about the middle of 2022. This is when the Fed started putting the brakes on rapidly increasing inflation. The Fed started raising interest rates at the fastest pace on record in almost 40 years. And what's transpired since then is current pricing is down anywhere from 10 to 30% from the peak. And you can see that is for pretty much all real estate sectors here. And then most recently, in the last couple quarters, you can see there's a potential that things are starting to take a turn, showing us that perhaps the worst is behind us. And really the goal for us here in sharing this slide is we're not trying to time the market. Nobody can do that correctly. But what we do see is that we are able to capture pretty significant discounts from the recent market correction that we've experienced. All right, let's dive in, guys, into the details of the portfolio. I want to share with you some of the attributes, the aspects that we like about it, some of the progression that we've already experienced here. And so the portfolio we're investing into was initially launched in 2023. SMK already has an investment in this portfolio. We invested in it a little over 12 months ago, and we're excited to add new capital as it continues to perform well. Now, we've remained active investors for this time. We've benefited from performance that has consistently met projections alongside steady quarterly distributions that we're receiving. As of most recently, the portfolio has grown to 17 properties. It includes 8 mobile home parks, 9 self-storage facilities across 10 states. And as part of our relationship and for the pooling and managing of capital with our group, we are able to negotiate more favorable terms from our operating partners. That includes a higher preferred return and a higher split to our investment entity, really making the net return to SMK investors very attractive. All right, some of the highlights. 92% of the assets have been sourced off market direct to seller. That is one of the competitive advantages that our operating partners continue to bring to the table. They have a team of 8 full-time, essentially acquisitions team, but they're cold calling mobile home park and self-storage owners every day. They've been doing that for almost a decade now, and they have a Rolodex of owners. And so they're able to essentially access off-market direct-to-seller acquisitions. Many of them that they choose to invest in are being mismanaged and have a big opportunity for growth. They focus on buying these underperforming assets from mom and pop sellers, again, who are mismanaging them. It provides us with nice upside potential. And as of recently, the portfolio had a very low conservative loan to value of just over 35%. So using leverage extremely conservatively, we actually expect that to go up and hope that it does. Maybe 60, 65%, I think, is the goal. But right now, very low leverage. The portfolio is expected to grow to over $200 million in equity and over 50 properties before our operating partners do close the opportunity. And so we're really excited about the idea of what they've created and repeat investing and continuing to allocate more capital to this portfolio. Okay, this is a portfolio summary. We're not going to dive into all the details on the screen just in lieu of time here today, guys. I would encourage you all to log into our website, look at the executive summary, and there's a lot more information specific to these properties. But what I want to share with you today, we've got over 3,200 total lots or self-storage units. The purchase price that they've paid thus far for these properties totals a little over $56 million. And the total debt is just under $20 million. So you have this, again, very attractive, low portfolio loan to value of 35%. Now, the interest rates on this debt range between 5% to 6.6%. And another important factor, if you see these NAs, that means that they purchased those properties all cash, which is something that they do from time to time when it makes sense. Their thought process and strategy there is you can get a great deal by paying cash and then grow the value in a short period of time and then turn the property over and put fixed rate long-term debt on it. That's really what they love to do. And so they've done that successfully numerous times, which I'll share with you in just a minute. But I also want you to look at the recent appraised values. You've got 4 self-storage properties that were recently appraised and have financing on them now after creating value. We're going to discuss those in a minute. And you also have 2 mobile home communities in Michigan that have a very similar growth and value since acquisition. We'll talk about those in just a second here. So in summary, this is a kind of a quick list of all the properties, photo. You can see the occupancy, and our operating partners are typically underwriting a project level IRR of 20% or more as far as projected returns, and a 2.0 or higher multiple on invested capital. Some more photos of the properties. If you look at this one down here, this is in Michigan. There's 2 mobile home communities close to one another, and they have a much higher projected IRR of 30% and a multiple invested capital of over 4x. And the reason for that, and you can look right above, occupancy is only 41%. And so this is very underperforming. It's being mismanaged. There is a huge opportunity to grow the value here, but there's also more execution risk, right? You need to bring in homes, used and new, sell or rent them to residents. And so for taking on that risk, they're expecting a much higher return on investment. But when you blend that with all the other properties in the portfolio, you get a very nice, stable income and growth in the whole portfolio. Some more properties here. These are another 3 properties in the North Dakota region. Now, in addition to those assets in the portfolio thus far, as I mentioned, our operating partners are going to keep growing the portfolio. Right now, they have $90 million in additional mobile home parks that they want to acquire by the end of 2024. You can see 2 of them pictured here. These are in the Midwest, totaling 237 sites. And the projected returns on this upcoming potential acquisition, again, IRR of over 20% and a multiple on invested capital of 2.3x. Now, the value add strategy at these communities, they are well under market as far as rent. So they're planning to increase the rents by roughly 15% in the first year. And they're also going to bring in more homes, increase occupancy, fill vacancy, and increase revenue. All right, so we believe that now is an ideal time to capitalize on this portfolio. It's already implemented, many value add measures. It boasts proven track record of success. It's very well diversified, and it's only going to continue to grow. And so let's share with you some of the performance. What have they been able to achieve thus far? And so you'll see here, net operating income has increased by 63% year over year. This is the column in blue, and these are for same store results. So already a significant increase there. You can see ancillary revenues. That's essentially other income, billing back of expenses, insurance, utilities, you name it, from 15 to 50,000 across year over year. As of 2024 Q2, the rent on the properties are now achieving 95% collections compared to 79% in 2023. And so by coming in and putting in professional management and enforcing rules, you're seeing a very significant increase in rent collections. They're also currently in process of sub-metering the utilities at 2 of the mobile home parks. That will increase revenue, and you can bill back that, and including the trash to the tenants. And they recently closed on a new $50 million revolving line of credit with KeyBank, which is a nice added stream of debt that they can utilize for additional liquidity and to acquire assets with. Let's take a look at an example of the self-storage properties that I shared with you previously. These are 4 properties here. You can see them at the bottom. Since they acquired them in 2023, they've been able to grow the asset value roughly 30%. And this is across 1,280 self-storage units. How'd they do this? Well, they increased the rent at the properties by 23%, and they added required tenant insurance. It's just another ancillary revenue stream. The result is 31% increase in total revenue, and a 50% increase in net operating income has been achieved since they acquired these properties in 2023. Total value is roughly $3.5 million that they've been able to grow the value of these properties at a 6.5 cap rate. And as a result of this, they essentially have now gone out and secured long-term fixed rate financing. There's a new loan of 8.75% on these properties, fixed for 10 years at 6.25%, and 10 years of interest-only payments. With this transaction, they were able to pay down the previous bank debt, and they netted approximately $3 million out of the deal, cash out, which is used and put back into the portfolio for additional value add measures and upgrades to the other properties. So really excited to see this happening already this early in the fund. Another great example of some of the value they've grown so far. Let's take a look at these two mobile home parks. These are in Michigan. There's 360 sites total, 94% occupied, and they just recently appraised for 46% above the initial purchase price. And we can break that down here in this table. But you can see the purchase price, $14.2 million in total for the two communities, recently appraised for $20.7 million. That's $6.5 million of valuation growth, roughly 46% total growth so far. And how did they do it, right? They did it by buying right first and finding these opportunities that have well below market rents. And so they increased lot rents 30% since acquisition. They've also recaptured $184,000 in annual revenue from utility expenses. The going forward plan is to continue to increase occupancy. They've got 5 new homes pending to be delivered to the communities, which should add additional value of $500K or so at a 6.5% cap rate. Now, the plan here is to move to long-term fixed rate financing in early 2025. After the properties have been owned for over a year, they will be eligible for much more attractive financing and essentially rinse and repeat like they did on the self-storage properties, hoping to pull back a lot of the capital that's already in these and reuse them for additional properties in the portfolio. Okay, so as we noted, we're partnering with a repeat operating partner. We continue to do very well with them. We have a lot more information on their firm, including an interview that you can listen to with them. But I just want to share a quick overview of their background and track record. Currently have over $500 million in assets under management. They're a vertically integrated operation, which means they have property management and construction management all in-house. Again, they have an internal acquisitions team of 8 that focuses on building relationships with owners, buying direct, not paying realtor fees, and really being able to acquire very attractive purchases. They currently have over 175 employees across 28 states. They manage over 25,000 units. And their principals have co-invested over $12 million across their portfolios and funds. And they are going to co-invest $5 million in this portfolio. They've already contributed some of that and will continue to contribute it as the portfolio grows. Here's a quick snapshot of their fully exited properties. So they've sold 33 assets, right? The proof's in the pudding here of their ability to execute. What you can see here is they've held on average these properties for 2.6 years. They've taken the total purchase price of $89.6 million, and they've sold them for $156.7. And so the average IRR here at the project level is 74%. Very attractive numbers here, and multiple on invested capital of 2.7x. So we're really excited to be partnering with them again. They're a very strong operator, and they have a very strong history of execution. Okay, we're moving to the end of the presentation, guys, but let's review the projected returns and next steps before diving into some questions here. So we have 3 class shares for investors: Class C with a minimum of 50,000, Class B minimum of 200,000, and Class A 500,000. Investors earn a preferred return which accrues annually from 7 to 8%, and the profit split above that is 70, 75, or 80% to investors and the balance to SMK. We have a projected investor equity multiple of 1.75x up to 1.85, and the projected investor average annual ROI of 14 to 17%. And that includes the quarterly distributions and cash flow, plus the property profit and sale. So when we look at cash flows, we're projecting investors to earn, in the first 1 to 2 years between 4 and 6%. In years 3 and 4, it goes up 6 to 8%, and year 5 on 7 to 9%. We have an annual management fee of 1% on invested equity, and we also have an acquisition disposition fee of the same. That's a one-time fee. And the investment term or duration is 5 to 10 years. We don't expect to hold principal and capital for the full term. We do anticipate that our operating partners will begin to return capital in years 4 through 5, as refinances and properties are being sold at that point. We do investor distributions and reporting quarterly. And as we noted before, we do anticipate depreciation to provide passive losses to investors in both 2024 and 2025. Now, the deadline for our first funding tranche is November 1st. And for early investors, we offer founder shares, which provide a higher preferred return each year for the duration of the investment. These shares are available on a first-come, first-served basis. We currently have already filled this allocation. And so if you have reserved founder shares, but you have not yet completed the offering documents or funded your investment, please make sure to do so by November 1st. Any unclaimed founder shares after that date will be offered to those on the waiting list. And if you're interested in founder shares, but you haven't reserved any yet, just contact us to be added to the list. We do anticipate we'll keep this opportunity open beyond November 1st for those who may not be able to fund in this first tranche. And I would encourage everybody to take a look at our website. You can log in and review the executive summary, listen to an overview of the deal with our operating partners, and look at further details. Okay, going to go ahead and open it up to questions and answers. If you guys haven't asked anything and you want to ask, why don't you go ahead and type it into the box? We've got several questions here. Just give me a second and I will get to them momentarily here. Okay, someone was asking, they have an attractive track record, fully exited properties. As we discussed, 33 of them. And while past performance is no guarantee of future results, is there sufficient evidence to think that they could have similar performance going forward? It's a great question. We believe so. As part of our due diligence, we looked at the pro forma projections and the actuals on the investments in the portfolio to date to see how they're doing, right? Are they tracking according to plan? And the net result was yes. You could even argue they're doing better than initially projected. And so we do hope and believe that they'll be able to have a very attractive performance and meet or beat the projected returns that we're showing. Of course, there's no guarantee. It's still early. As I mentioned, there's 17 properties in the fund. We expect that to grow to 50. They've told us on numerous calls and part of our due diligence with the CFO and the operating team that they have essentially never seen the kind of demand from sellers that they're seeing now, especially on mobile home parks. They're really excited about some of the opportunities that they're able to source. And so it does look like that they're going to be able to continue this trend, but of course it's a risk. And so I'll also add that since we've been investing last year in this portfolio, we've received distributions quarterly, like clockwork. They are ranging anywhere from 5 to 7% each quarter. And so that's all from free cash flow from the properties that are performing in the portfolio thus far. And so we believe that they'll be able to hit their numbers. Obviously, there is no guarantee, but we're excited about what we've seen so far. Otherwise, we wouldn't be putting additional capital into this portfolio. Okay, let's keep going with questions here. What are some of the risks of this investment? Yeah, great question. I think, in my opinion, some of the risks it's human risk, right? You have operational execution. There's a little bit more value add to be done on some of these properties. You have to come in and roll up your sleeves, and you've got to improve occupancy. You've got to ensure that tenants stay and pay, and there's a lot of work to be done. And so you're relying on the team that's been doing this for years and so far has a great track record at execution, but you always have execution risk. I think that's probably one of the biggest. I do think that some of that risk is essentially mitigated through the fact that we're in a portfolio with multiple properties, multiple locations, varying degrees of difficulty, if you will, from a business plan and execution standpoint. I think that's probably the biggest risk from my view, but I do believe that our operating partners are mitigating against it quite well. Okay, when do I begin to accrue a return? Okay, this is something we discuss in our FAQs, and when will distributions likely begin? Right, so the fund that we're investing into is structured with a waiting period. It essentially means that our capital as investors is put to work and begins accruing a return once our operating partners use the capital to acquire the properties. So it's a common process that a lot of portfolios utilize. Essentially, investors' capital begins to accrue a return once our operating partners use the money to buy properties. And so we estimate that it can take anywhere from a few weeks to potentially up to a few months, depending on our operating partner's acquisition pipeline. But it will not exceed 2 quarters. That's something that is in the offering documents at the operating partner level. And so we'll notify all investors once capital begins to accrue return. We do think it'll happen a bit sooner because of the pipeline that they have ready to close on in the coming quarters here. So what are the projected exit cap rates? Underwriting assumes a 6.5 to 7 exit cap. So they are buying and seeing today's market cap rates, in the mid 5% range, give or take. And so they are underwriting to increase in cap rates. We'll see if that happens. It's anybody's guess. The Fed obviously recently just lowered interest rates for the first time in 4 years. We think that the cycle has changed and we're in a different market cycle now. As I showed in some of the slides and one of the charts that showed the pricing of commercial real estate asset classes essentially has dropped, 10, 20, 30%, depending on location and vintage and asset class. And so it's common to hear folks in the industry think that cap rates will be flat or potentially start to decline in the near term. But our operating partners are not underwriting to that. They take a conservative approach, underwrite to 6.5 to 7% exit cap rate. And so that is an advantage that we like to see. We always, of course, are looking for conservative underwriting. Okay, how much of the portfolio is in mobile homes versus self-storage? Okay, good question. So we have a slide on this in our executive summary. It discusses kind of the allocation between the 2 different asset classes. Right now, the net operating income that's being produced from these assets is split 70% in mobile home communities and 30% in self-storage. And so it's a little bit more weighted, of course, to mobile home parks. We are perfectly fine and content with that. If I had to pick, I would pick mobile home communities as my first option or choice to invest in over self-storage. I think self-storage and certain apartments are a close second, but we love the allocation. It's hard to know exactly where that's going to go, right? 17 properties in the portfolio thus far. We expect that to grow tremendously to roughly 50 or so before the portfolio is completely allocated and closed. And so you have a likelihood that it's going to continue to be weighted more towards mobile home parks, but we can't say or assure anybody of the exact allocation. And our operating partners don't either, right? They look at this as more of where can we find the best deals, not necessarily trying to keep a balance. And if they find the best deals to be more in mobile home parks, well, then we'll be more weighted towards that asset class. All right. Yes, we do accept self-directed IRA investments. If you don't have an account or if you have any questions on how to do that, let me know. I personally have a self-directed IRA. A lot of our clients do, my family members do, and I'm happy to point you in the right direction there. Okay, any other questions at this point, guys? Just let me know. I'm going to give it another minute or so here. We'll leave this Q&A section open. Okay. Yeah, good question. So we've heard this before. This is a question about, since the portfolio was opened in early 2023, what's the difference in, how did he word it? Well, what is the time value of money for people who got in early versus those that are coming in a little bit later? Yeah. So, okay, I think we addressed this in our executive summary as well. We've been asked this a couple times. Essentially, what's the difference between those investors that got in last year and those that are getting in now? And so the way that this is managed is pretty common, but our operating partners utilize a net asset value that started at $1,000 per share last year in 2023. And this increases quarterly. And so as of Q2 of 2024, it was up 6%. It was $1,060. And so, you could argue, well, the earlier people were getting a better deal than the later people. We don't necessarily look at it that way. It's more of a balance of risk versus reward, where earlier investors are essentially taking on more risk. They're entering or investing into a blind or semi-blind fund that may not even have any properties in it yet. They probably have not executed on any of the value add measures. There's been no valuation growth. A lot more uncertainty at the beginning of these kinds of funds. And so later investors are experiencing, lower risk. As we shared, the fund is more established and becomes, essentially lower risk because you've seen some value add measures grow. You've seen performance generating consistent returns. You're much more diversified. Again, 17 properties right now in the portfolio. But to add context to this, in our operating partner's previous fund, the price per share increased over 36% before they closed the investment to new capital. And so in relation to that, we're still quite early in this process and getting in at what we think is an ideal time where the net asset value has not increased that much, but we already have significant amount of performance and lower risk. Okay. I think that's it for now, guys. I appreciate your time. I'll just mention one more thing here that if you're interested in an investment, feel free to log in, take a look at the details in our executive summary, and reach out with any other questions that I can assist with. Have a great day. Thank you all.